Welcome to the deep dive. Today, we're zeroing in on a company many folks probably still associate mostly with, well, jam. But the JM Smucker Co. is way more diverse than that. We're talking huge names in coffee, peanut butter, pet food, even snacks like Twinkies now. And we're diving into their fiscal 2026 first quarter results, which just wrapped up July 31st, 2025. What's caught our eye is that Smucker's actually exceeded its own expectations, which is pretty notable given what they call a dynamic external environment, code for a tough, unpredictable market. So we'll look at the numbers, sure, but also the stories behind them, the strategies, the consumer trends.
Exactly. And these earnings reports, they're really valuable. They give us this rare glimpse into how these big consumer brands are actually doing. It's not just about spreadsheets. It's about the challenges they're facing, how they're trying to adapt, and what it means for the future. We'll break down the financials, but really connect it to the things you see on the shelves every day.
Okay, so with that set up, let's get into it. Smucker's talked about accelerating organic growth as a top priority. Where are we seeing that happen? Let's start with, well, maybe the most talked about one, Uncrustables. It's almost funny how big these things have become. They're saying it's infusing itself into pop culture, social media, and the numbers back it up. Double-digit net sales growth again this quarter. That's on top of huge gains last year. And get this, they have the #1 single product, the Ski U, in the entire frozen category, and 2 in the top 10. How much is that? Just like lightning in a bottle.
Well, it's definitely caught fire, but there's a lot of strategy behind fanning those flames. It's not just luck. What's really interesting is how they're managing both that sort of viral organic buzz and very deliberate marketing and distribution. They're pulling in new buyers, sure, families with kids, but also, crucially, millennials and Gen Z are jumping on board.
Right, so it's broadening its appeal.
Exactly. And the distribution piece is key. They're pushing way beyond just the grocery store freezer aisle. We're talking over 30,000 convenience stores now. Think about that impulse buy potential. They've got commitments from most of the big C-store chains.
Ah, okay, so grabbing people on the go.
Precisely. Plus, they keep innovating. The peanut butter and raspberry one was popular. They did a limited berry burst. Now there's a PB Choco craze coming. That keeps it fresh, keeps people talking. And they say it's highly incremental, meaning it adds new sales, not just shifting existing ones.
And the goal is huge, right? $1 billion.
$1 billion in net sales by the end of this fiscal year. If they hit that, it'll be the 12th straight year of strong double-digit growth. It really is a case study in modern brand building.
Taking something simple and just constantly finding new ways to sell it, new places to put it.
Yeah, the challenge, is always sustaining that momentum. Can they keep innovating fast enough without diluting the core brand? That's the balancing act.
Okay, so Uncrustables is a phenomenon. But let's shift gears from sandwiches to sips. Cafe Bustelo, another success story here, apparently. One of the fastest growing brands in at-home coffee. That's a competitive space.
It really is. And Bustelo's growth is significant. They reported, 36% net sales growth in U.S. retail coffee overall.
Yeah, 36%, including a 17% volume mix increase. So people are buying more of it, not just paying higher prices.
Right. And if you connect that to the strategy, it makes sense. They've ramped up national marketing, trying to boost awareness and get it into more households. And they explicitly say there's still significant runway left for growth. They think it can get much bigger.
So they see untapped potential.
Definitely. And they've also launched new roast profiles, both in the cans and the single-serve cups, which retailers seem to be embracing. It suggests maybe a consumer shift towards value, but also like bold, distinct flavors, maybe moving away from some traditional brands.
Interesting. So Bustelo is really capitalizing on that.
Seems like it. They expect another year of double-digit growth for the brand.
Okay, let's talk pets. The pet segment seems a bit more varied. A mixed bag, maybe. Milk-Bone sales were down. They mentioned lapping previous distribution gains, but also consumers being maybe a bit cautious with spending on treats.
Yeah, that's the narrative. Dog treats like Milk-Bone can be seen as more discretionary. When money's tight, maybe Fido gets one less treat. But it's nuanced. They also point out that the overall dog snacks category has actually been rebounding lately.
Oh, okay. So maybe Milk-Bone's dip is more specific to them, or just normalizing after a big push last year?
Could be a bit of both. Plus, that general consumer caution on non-essentials.
But Meow Mix is doing well.
Meow Mix is still showing momentum. Strong double-digit distribution gains for dry food, plus some innovation like these gravy bursts seem to be working. And Smucker's is still very bullish on pets long-term. They talk about positive population trends, people treating pets more like family humanization trend.
Spending more on them.
Right. And premiumization, especially online. So the long-term picture looks good, but it does raise that question. How fast can a brand like Milk-Bone pivot if consumers are tightening their belts on treats, even temporarily? How do you balance value with those premium trends?
Yeah, that agility seems key.
Hmm.
Okay, let's turn to Hostess. This was a big acquisition, and they're using words like decisive actions to stabilize. That sounds challenging. Comparable net sales for sweet-baked snacks down 10%. Oof, that definitely points to pressure in that discretionary category.
It's definitely a challenge. Turning around an iconic brand isn't easy, especially when it's in a category people cut back on first. But their stabilization plan sounds quite disciplined. They're doing a major SKU optimization.
Meaning cutting products.
Exactly. Cutting the number of distinct products by 25%.
Yeah.
The idea is to ditch the slower-moving, lower-margin stuff and really focus on the winners, the Twinkies, the core donuts, things that sell fast and make good money.
Trimming the fat, basically.
Pretty much. And they're making big operational moves, too, like closing the manufacturing plant in Indianapolis.
That's a big step. Cost savings.
Substantial savings expected. $10 million just in the last quarter of this fiscal year, and then $30 million a year after that.
Okay. So, focusing the portfolio, cutting costs. Are there any green shoots, any signs it's working?
They say there are early positive signs. Things like improving base velocities, meaning products are selling faster off the shelf again, and they've regained some market share with key retailers. And you can't forget, Hostess is iconic. People know Twinkies, Ding Dongs, they lead in packaged donuts.
Right, that brand recognition has to count for something.
It does. And Hostess donuts, specifically, are called out as a bright spot. They're actually seeing dollar and volume growth there. Maybe people see donuts as more of a breakfast item, less purely discretionary.
Interesting distinction.
So the approach seems to be leverage the icons, improve efficiency, and be patient. But the risk is always there. Will it be enough against those category headwinds?
Okay, so that gives us a feel for the key brands. How does this all roll up into the bigger financial picture? How are they handling things like inflation, costs?
All right, let's connect those dots. We mentioned the U.S. retail coffee segment saw that impressive 15% sales jump.
Yeah, which is striking given they also mentioned record high green coffee costs. They did raise prices in May and August to cover that. But how much can you raise coffee prices before people, just drink less or switch? Is there a limit?
That's the million-dollar question, isn't it? And coffee is tricky. Green coffee is, as they put it, an unavailable natural resource in the U.S. at scale. It needs a tropical climate. So you're exposed to global markets, weather, and tariffs. The U.S. tariff impact, specifically on green coffee, is hitting them harder than expected.
How much harder?
And they now expect it to be a 50-cent headwind to their adjusted EPS earnings per share for the full year. That's up 25 cents from what they originally thought. That's a direct hit.
Wow, okay. But people are still buying.
Apparently, yes. They said price elasticity of demand trends have been favorable. Basically, consumers grumbled less or switched away less than they feared. It shows the resilience of that at-home coffee habit. People love their daily ritual.
And it's still cheaper than a coffee shop.
That's the key comparison they make, keeping it an affordable price per serving relative to alternatives. But it's a very delicate balancing act. Push prices too far, and you eventually hit that tipping point.
Okay, so let's recap the overall Q1 numbers then. Net sales down 1%, but comparable sales up 2%. Can you unpack that difference?
Sure. Net sales includes everything. Comparable sales adjusts for things like businesses they've sold off, divestitures, and the impact of foreign currency exchange rates. So the like-for-like business grew 2%.
Got it. But profits were down more significantly. Adjusted gross profit down 11%, operating income down 17%.
Right. And adjusted earnings per share was $1.90. That's a 22% drop from last year.
So despite some brand successes, the cost pressures really bit into the bottom line.
Exactly. Higher commodity costs like that coffee, unfavorable volume mix in some areas, plus some impacts from financial derivatives. The price increases helped offset some of it, but not all.
So given that profit squeeze, what does their outlook for the rest of the year look like?
This is where it gets interesting. Despite the Q1 profit drop and the higher tariff forecast, they actually raised their full-year net sales forecast.
Raised it. Based on what?
Primarily based on the strength and pricing power they're seeing in coffee. They now expect full-year comparable net sales to be up 3 to 5%.
Okay. And earnings? Are they lowering guidance there because of the tariffs and costs?
No, they're maintaining their existing adjusted EPS guidance range of $8.50 to $9.50 for the full year.
So they expect things to improve or they have other levers to pull?
It suggests confidence that they can manage those costs, maybe through productivity savings, or that the sales mix will improve later in the year. They did signal Q2 earnings would likely be down again, but then improve sequentially after that. And another positive point, they raised their free cash flow projection for the year by $100 million, up to $975 million.
What's driving that?
Partly thanks to something called the One Big Beautiful Bill Act legislation that gives them some accelerated tax deductions for R&D and equipment depreciation. So a bit of a legislative tailwind there.
Okay, so navigating headwinds, but also finding some tailwinds. This seems to tie into their bigger strategic goals, right? They talk about embedding transformation and fostering a be bold mindset.
Exactly. It's not just about managing quarter to quarter. They have this transformation office that they say delivered on its goal of $100 million in run rate cost savings and productivity benefits.
Right, those hostess synergies and plant closures fit into that?
They do, and that be bold mindset likely translates to encouraging more innovation, like Uncrustables, taking calculated risks, and not just sticking to the old ways. The long-term goal is generating over $1 billion in free cash flow every year.
And they mentioned paying down debt, too.
Yes, that's a big part of the financial discipline piece. They plan to pay down about $500 million of debt in each of the next 2 fiscal years.
That's significant. What's the target?
They're aiming for a leverage ratio that's net debt compared to EBITDA, a measure of earnings of around 3 times by the end of fiscal 2027.
And where are they now?
Currently around 4.3 times. So getting that debt down significantly strengthens their financial flexibility for the future. It shows they're thinking longer term, strategically positioning the company, not just reacting.
So bringing it all together, this deep dive into Smucker's Q1 really shows a company juggling quite a bit. You've got these star brands like Uncrustables really driving growth, fueled by, savvy marketing and distribution. Then there's the coffee segment, showing resilience even with high costs and price hikes, but also facing challenges in stabilizing Hostess and navigating those tricky discretionary categories like pet treats, all while focusing on efficiency and paying down debt.
It absolutely highlights that constant tension for companies like this. How do you innovate, keep consumers excited, and deal with unpredictable external stuff like tariffs, commodity spikes, and shoppers maybe tightening their belts? It kind of makes you wonder, doesn't it? As consumers, how much do we really notice that complex dance between global markets, corporate strategy, and just, getting our favorite snacks or coffee onto the shelf? And what power do our own buying choices really have in that whole equation?